You need to get your revocable trust in place. I call this an I love document. You say, Colin, revocable, what does that mean? Well, it means you can change your mind. The assets are still yours. And it's really more or less a planning tool. It doesn't necessarily protect the assets from creditors, and it's not irrevocable, and thus the assets are included in your estate. But it does remain private, and it will simplify life for the people that you love. That's why I call it an I love you document. Hey folks, this is Colin Richards, president and founder of Lord & Richards, and I'm excited to present to you this concluding episode on both the financial independence, or what we call the Lord & Richards roadmap, as well as our little mini-series on estate planning. And it is so critical that we get an estate plan in place. Hopefully in the prior segments that I have already taught you, you have sufficient urgency now that you know you need to get it. But now the next step is, how do I create that? What's going to be involved in that? Well, first of all, your estate plan is going to be written, and we're going to get your key documents in place, starting with powers of attorney, making sure that people, whether you're sick or incapacitated, have control over your finances and healthcare that you implicitly trust, right? Not the ex-wife or somebody that really isn't a part of your life anymore. And a lot of times these need to be regularly reviewed to be kept up to date. We're going to have living wills and advanced directives to make sure that your wishes are honored about special health circumstances, whether or not you want to be kept alive, and so forth. Your written estate plan is going to figure out how you're going to treat the kids. Are we going to distribute things to them equally? Are they going to get a portion and the rest go to charity? Or are some going to get more or less based on kind of their contribution in later life to your health and your welfare? We're going to figure out where charities fit, and especially we're going to use those for your tax advantage now, okay? We have a lot of really cool things we can do when it comes to giving that will save you now, not just in the end. And so I recommend getting a lot of that giving done while you're living, to take advantage of the current tax benefit that you receive on these. And our goal in the end is to reduce or eliminate taxes. Just like on our written tax plan, we're going to extend that now to include what happens on death. So right after you get these documents, your living wills, your advanced directives, your powers of attorney, these will all be included. And remember, we have a wonderful estate planning attorney that will do this at a greatly reduced rate. You need to get your revocable trust in place. I call this an I love document. You say, Colin, revocable, what does that mean? Well, it means you can change your mind. The assets are still yours. And it's really more or less a planning tool. It doesn't necessarily protect the assets from creditors, and it's not irrevocable, and thus the assets are included in your estate. But it does remain private. It directs the transfer of assets so you know where things are going to go. You can guarantee where things are going to go. And it will simplify life for the people that you love. That's why I call it an I love you document, because it makes things so much easier than chasing down assets that have all kinds of different titling and where the beneficiaries aren't clear. Next, we're going to look at the possibility that you might need an irrevocable trust, okay? For those who are higher net worth, this is vital. This will help you avoid estate tax either now, or if your estate grows to fall outside of those current limits on estate taxes. It'll potentially protect you from creditors. So there's a lot more there than meets the eye. And you can place inside of your irrevocable trust a tax-free tool such as life insurance or municipal bonds to avoid income tax and be able to have an asset that generates tax-free income for you. Next, we want to look at, do we want to start giving some money away? You have an annual gift tax exemption that does not reduce your lifetime federal gift estate tax exemption. Okay, so you can give up to $19,000 if you're married. You can do this. Let's say you want to gift to one child. Each of you can give to that child $19,000 per year, and it doesn't have to be reported as taxable income to that child. So avoids the gift tax, and it does not reduce, again, your lifetime exemption. So if you're doing estate planning as well, you can do these things separately. And you can do this for anybody you want. It doesn't have to be a relative. So you could start giving money away to all the important people in your life. But we want to have that as part of a strategy, right? Part of your written plan with Lord & Richards that we provide free of charge comprehensively to you. Then, of course, as we've talked about, we want to make sure that we're aware of those lifetime gift tax exemptions, the generation skipping tax exemption, transfer tax exemption, and so forth. If you gift over and above your either annual or lifetime exemption, that's when we're going to hit an 80 to 40% tax on gifts. So we want to avoid that. So let's plan now and not like cram it all in at the end of life, right? The estate and gift generation skipping transfer tax will apply to anyone that you gift money to 37 and a half years younger than you as the donor. You're going to pay 40%. Now, that's better than it was in the past. If you're above that exemption, if you say, well, Colin, right now, we might have a problem. We've been blessed and we have significant assets, then we can look at the possibility of a perpetual trust or what's called a dynasty trust, okay, to have kind of an extended legacy that moves multi-generationally. You'll still have to pay taxes on income generated inside of that trust, but it's pretty cool. You can put non-income generating assets like stocks that don't have paid dividends or double tax-free municipal bonds that aren't taxed at the federal or state level, as well as life insurance again. And that tool is something we use at Lord & Richards that a lot of financial planners are afraid of simply because they don't understand it. They don't understand how to get the cost of that down so that it's not an issue for you. And then finally, we want to maximize in your estate plan gifts to charity, right? So you've got a standard deduction this coming year of $19,000, okay? That doubles, right? If you're, or pardon me, of $15,000, and that doubles to $30,000. So a pretty healthy standard deduction. But you can continue to itemize over and above that. Just because you're getting that standard deduction doesn't mean you can't give a lot to charity. The problem is that it's got to be over and above that $30,000 for it to count. But here's the cool part. If you want, we can develop a donor advised fund or a foundation for you to receive tax deductible contributions. Okay, you control it, and it's tax deductible, and we can heap those together in a single year to try to maximize your deductions. And of course, if you're over 72, we got a really cool tool called a qualified charitable distribution, so that you can use money over and above your exemption. So on top of your exemption to gift to charity. Folks, we need to have a conversation. It simply starts with a phone call.